Trading stopped. Not for seconds, not for a glitch, for 11 full minutes, while billions moved silently in the background. They called it technical. They always do. But the data tells a different story. A story about who really controls the price you see on your screen, and why they needed the market frozen to finish what they started. What happened in those 11 minutes will change how you look at silver forever. Welcome to Currency Archive. Now, if you've been around long enough to know that nothing in these markets happens by accident, then this channel was built for you. If this is your first time here, do yourself a favor, the kind you'd give a trusted friend, and hit that subscribe button. Because what we cover here, you won't find on mainstream financial news. And before we go further, tell me in the comments, where in the world are you watching from right now? I'm always curious which part of the world is paying attention. On a Wednesday morning, something unusual happened. The kind of unusual that doesn't make front page news. The kind that gets buried under market updates, earnings reports, and political headlines designed to keep eyes looking everywhere except where they should be looking. Trading was halted. Not in some obscure corner of the market. Not in a small cap stock that nobody watches. In silver. One of the most historically significant stores of value on the planet. A market that moves trillions of dollars across borders, through institutions, through central banks, through the hands of ordinary people who simply wanted to protect what they had built. It stopped. For 11 minutes, the machinery that is supposed to run without interruption, the machinery that governments and financial institutions have spent decades convincing the public is reliable, transparent, and fair, went completely silent. The official explanation came quickly. Too quickly, some would argue. They called it a technical issue, a routine circuit breaker. Nothing to see here. Markets resumed, prices adjusted. And within hours, the news cycle had already moved on to the next story, but the price told a different story. Before the halt, silver was pushing against a critical resistance zone. Traders who had been watching the chart closely knew that a breakout above that level would have triggered a significant wave of buying. Stop losses would have flipped to long positions. Momentum would have built. The kind of move that, once it starts, is very difficult to stop. Then the halt came. And when trading resumed, silver didn't break out. It dropped. Hard. From the upper range down to 87.20. A level that, not coincidentally, had been identified weeks earlier as a key technical zone. Former resistance now acting as new support. A level that sophisticated traders had marked on their charts long before that Wednesday morning arrived. This is not how random technical failures behave. Random failures don't pause markets at the exact moment a breakout is forming. Random failures don't result in price moving precisely to a pre-identified institutional level the moment the pause ends. Random failures don't benefit the same category of player every single time they occur. What happened that Wednesday followed a pattern, and patterns in markets are never accidental. To understand why this matters, one must first understand what silver actually represents in the modern financial system. Silver is not simply a metal, it is a measuring stick. When its price rises too quickly, it sends a signal to the broader market. A signal that confidence in paper currency is weakening, that inflation expectations are rising, that the financial system may be under more stress than official reports are willing to acknowledge. Powerful institutions have a strong interest in controlling that signal, not because they are afraid of silver specifically, but because they are afraid of what an uncontrolled silver price communicates to millions of ordinary investors, business owners, and entrepreneurs who are watching the markets for honest information about the real state of the economy. A managed silver price is not about silver. It is about narrative control, and on that Wednesday morning, the narrative needed management. Because just days later, a critical piece of information entered the public domain. Jane Street, one of the most sophisticated quantitative trading firms on the planet, had quietly added 20.6 million SLV shares in the fourth quarter alone. Their total position had grown to a $1.3 billion stake, making them the single largest holder of the silver ETF on record. This was not a passive investment. Firms like Jane Street do not accumulate $1.3 billion positions to sit quietly and wait. They accumulate to operate, to influence, to extract edge from a market that moves in response to their own actions. They are not investors in the traditional sense. They are engineers of price action. And the halt on Wednesday gave them exactly the conditions they needed to work with. The question serious analysts began asking was not whether the halt was connected to this accumulation. The question was how long this had been planned. And the answer to that question requires looking not at Wednesday alone, but at everything that came before it. There is a game being played inside silver markets. Most people never see it, not because they lack intelligence, but because the game was specifically designed to be invisible to anyone who isn't looking for it. The rules were written by institutions that operate in the space between public information and private knowledge, a space where billion-dollar decisions are made before ordinary traders even finish their morning coffee. Jane Street lives in that space. To understand what happened around that Wednesday halt, one must first understand what Jane Street actually is. On the surface, they appear to be a trading firm, technically accurate, but fundamentally misleading. Jane Street is better described as a precision instrument, a mathematically engineered machine built to extract value from markets with surgical consistency. They do not guess. They do not speculate in the way retail traders speculate. Every position they take is calculated. Every entry, every exit, every accumulation phase is mapped against probabilities that most market participants never have access to. When Jane Street added 20.6 million SLV shares in a single quarter, that decision did not emerge from optimism about silver's future. It emerged from a strategy, and that strategy has a structure that, once understood, changes how a serious analyst reads every price movement that follows. Here's how it works. The first phase is accumulation. This is the quiet phase, the phase designed to go unnoticed. Institutional players begin building their position slowly across multiple trading sessions, using methods that disguise the true scale of their buying. They do not move price dramatically during this phase. In fact, they prefer price to remain suppressed while they accumulate, because every dollar lower in price means more shares acquired for the same capital outlay. During this phase, the public narrative around silver is typically bearish. Analysts appear on financial media expressing caution. Reports circulate about weak industrial demand or dollar strength. The environment is carefully managed to discourage retail participation, while institutions quietly fill their books. By the time accumulation is complete, the institutional player holds a position large enough to influence price action at will. The second phase is positioning. This is where options enter the picture. When the majority of retail traders have turned bullish, when sentiment indicators are showing widespread optimism, when silver forums are filled with excitement, when the chart is pressing against key resistance, put options become unusually cheap. The market has priced in continued upside. Downside protection is being ignored. This is precisely when institutions buy puts in significant size. Not because they believe silver will fall naturally, but because they intend to make it fall. The put options are not a bet. They are the second half of a two-part mechanism. The accumulated shares are the trigger. The put options are the profit engine. The third phase requires only one action. They sell. Not gradually, not carefully, all at once. A sudden, concentrated dump of the accumulated position hits the market with enough force to break through technical support levels, trigger retail stop losses, and create the appearance of a broad market panic. Traders who entered long positions during the bullish sentiment phase are now underwater. Fear spreads faster than analysis. Emotional selling accelerates the decline. And while that chaos unfolds in the spot market, the put options, purchased quietly days or weeks earlier, are generating returns of hundreds of %. This is not speculation about Jane Street's intentions. This is a documented playbook that regulators in multiple countries have examined in detail. The Securities and Exchange Board of India did not bar Jane Street from Indian markets in July 2025 over a minor procedural disagreement. SEBI accused them of generating approximately $550 to $567 million in unlawful gains through coordinated strategies on specific expiry days, using morning buying activity to influence index levels before profiting on pre-positioned options. The pattern was the same: accumulate, position, execute, profit. What changes between markets is not the strategy. What changes is the asset, the geography, and the timing. The architecture underneath remains identical because the architecture works. Now bring that understanding back to Wednesday. A halt at the exact moment of a potential breakout. Price dropping precisely to a pre-identified institutional support zone the moment trading resumes. A $1.3 billion position already in place before any of it happened. This was not a technical failure looking for an explanation. This was an explanation designed to cover a technical execution. History does not repeat itself in markets, but it rhymes with a precision that should make every serious analyst deeply uncomfortable. Because what happened on that Wednesday morning was not new. It was not unprecedented. It was not even particularly creative. It was a variation of something that has been executed before, in different markets under different names with different assets at the center, but always with the same outcome, the same category of player walking away with the same category of profit. While the same category of ordinary participant is left holding losses they were never meant to recover from. The uncomfortable truth is this: the halt was not the event. The halt was the reminder. A reminder that the rules of this game were written long before most of the people playing it were born. And the institutions writing those rules have had decades to refine them, test them, and protect them from serious examination. To understand the full weight of what Wednesday represented, one must travel back. Not to last month, not to last year, but to a period when the same architecture of control was being stress tested in a market thousands of miles away, and when regulators actually caught a glimpse of what was happening beneath the surface. India, 2024 into 2025. Jane Street had been operating in Indian derivatives markets with a level of sophistication that local participants struggled to compete against. On paper, everything appeared legal. Trades were executed on registered exchanges. Positions were disclosed where required. The firm operated within the technical boundaries of the rules as written. But SEBI, the Securities and Exchange Board of India, began noticing something that the raw trade data alone could not fully explain. On specific expiry days, coordinated morning buying activity was pushing index levels in directions that appeared to benefit pre-positioned options held by the same entity doing the buying. The buying itself was not illegal. The options themselves were not illegal, but the combination, the deliberate sequencing of one to engineer the outcome of the other, was something SEBI determined crossed a line. The number they arrived at was not small. Approximately $550 to $567 million in alleged unlawful gains, tied not to a single incident, but to a repeating pattern across multiple expiry dates. A pattern systematic enough that SEBI temporarily barred Jane Street from Indian securities markets in July 2025. The firm denied wrongdoing. Legal proceedings continued, but the significant detail, the detail that serious analysts should not allow to pass without examination, is not the legal outcome. It is the pattern itself. Because that same pattern, accumulate, position on options, engineer a price move, extract profit, did not originate in India. India was not the laboratory. India was the evidence that the laboratory had already produced a working model, a model refined elsewhere, exported to new markets, and executed with enough sophistication that regulators spent months simply trying to document what had happened before they could begin explaining why. Now bring that history forward. Silver markets in the West operate under a different regulatory framework than Indian derivatives exchanges. The participants are different, the instruments are different, the oversight mechanisms are different, but the human incentive structure underneath is identical. And when an institution that has already demonstrated willingness to deploy this strategy in one market acquires a $1.3 billion position in another, the analytical question is not whether the same playbook applies. The analytical question is which chapter they are currently on. The 87 to 89 support zone that held after the Wednesday halt was not a coincidence of technical analysis. That zone had been publicly discussed, charted, and identified by market analysts weeks in advance. Institutional players with access to order flow data know exactly where retail stop losses cluster. They know where the technical levels are because they read the same charts everyone else reads, and then they use that information asymmetrically. When price dropped to 87.20 after the halt and bounced precisely from that zone, it was not the market finding natural support. It was the market behaving exactly as it was designed to behave. There is a longer pattern here that predates Jane Street entirely. Silver has been the subject of documented manipulation allegations for decades. In 2020, JP Morgan Chase paid approximately $920 million to resolve allegations of precious metals market manipulation, specifically spoofing strategies in silver and gold futures that spanned nearly a decade of trading activity. One firm, nearly a decade. $920 million settlement. And yet the structure of the market remained largely unchanged after that settlement, because the settlement addressed the individuals and the specific tactics. It did not address the underlying architecture that made those tactics possible in the first place. That architecture is still standing. It was standing on the Wednesday the halt occurred. It will be standing the Wednesday after this one, and the Wednesday after that. Because the architecture was never dismantled, it was simply handed to more sophisticated operators who learned from the mistakes of the ones who came before them. This is the pattern they hoped serious analysts would forget. Not the individual incidents. Individual incidents get headlines, settlements, and temporary bans. What they hoped would be forgotten is the thread that connects every single one of them. When the dust settled after Wednesday, the chart told a story that most retail traders completely missed. Not because the information was hidden, not because the data required special access or privileged connections to interpret, but because most market participants were still processing the emotional shock of the halt itself, still reacting to what had happened, while the smart money had already moved 3 steps ahead and was quietly positioning for what was coming next. This is the fundamental asymmetry that separates institutional players from everyone else. Retail traders react to price. Institutional players create the conditions that generate the reaction. And by the time the reaction is visible on a chart, the institutional position is already set. The trap is already loaded. All that remains is waiting for enough ordinary participants to walk into it. So what exactly did the data show after Wednesday? Silver dropped hard from the upper range. It found support at 87.20, precisely within the 87 to 89 zone that technical analysts had identified weeks earlier as a critical confluence area. Former resistance flipped to new support. Price bounced from that zone back toward 90. Then it failed. Hard. And dropped again, this time to 85. Two levels now demanded serious attention. The first was the 87 to 89 zone. This area had now been tested multiple times. Every test of a support level in a manipulated market carries a dual meaning. On the surface, repeated tests suggest strength. The level is holding. Buyers are defending it. Sentiment may be stabilizing. But beneath the surface, repeated tests of the same level serve a different institutional purpose. They identify exactly how much retail buying pressure exists at that zone. They measure the depth of the order book. They probe for the precise point at which enough stop losses cluster below to make a breakdown worth engineering. In other words, every bounce from 87 was not necessarily a victory for bulls. It was data collection for the next move down. The second level demanding attention was the 150 exponential moving average sitting at 85. This is not an obscure indicator. The 150 EMA is widely tracked. It has acted as significant support in previous silver market cycles. When price approaches a widely watched technical level, institutional players are fully aware that retail traders will be watching it closely, placing bids near it, setting stop losses just below it, making decisions based on whether it holds or breaks. That awareness is itself a strategic asset, because a market where everyone is watching the same level is a market where the reaction to that level breaking becomes entirely predictable. And predictable retail behavior is the raw material from which institutional edge is extracted. Now examine what Jane Street's $1.3 billion SLV position meant in this specific context. A position of that scale does not move easily. It cannot be exited quickly without moving price significantly against itself. This is a structural reality of large institutional positions. Their very size creates constraints on how and when they can be deployed, which means that whoever holds a position of that magnitude must plan their exit, or their next accumulation phase, with considerable advanced preparation. The post-halt price action, the drop to 87, the bounce to 90, the failure, the secondary drop to 85, reads less like natural market discovery and more like a controlled sequence. A sequence designed to shake out weak retail longs, compress price into a tighter range, and create the conditions for the next phase of the strategy to execute cleanly. Smart money does not chase price. Smart money creates the environment in which price has no choice but to move in the direction they have already positioned for. And the environment being created in silver, through the halt, through the engineered volatility, through the precise interaction with key technical levels, pointed toward one of two outcomes. Either institutional accumulation was continuing at suppressed prices, building an even larger position ahead of a controlled price release to the upside, or the distribution phase had begun. A gradual, carefully managed exit from the $1.3 billion position that would push price lower in stages, extracting value from put options positioned in advance, while retail participants interpreted each decline as a buying opportunity. Both scenarios share one common element: the ordinary participant loses, not because they lack information, not because the charts are unavailable to them, but because by the time the pattern becomes visible enough for a retail trader to act on it with confidence, the institutional player has already moved to the next phase. The information arrives too late to be useful. And acting on late information in a manipulated market does not just fail to help. It actively feeds the machine designed to extract value from exactly that kind of delayed reaction. This is what the smart money did after Wednesday. They watched the chart they had already written play out in real time. They observed retail sentiment shift from panic to cautious optimism as price bounced from 87. They noted exactly how much buying pressure emerged at each technical level. They recorded where the conviction was strong and where it was thin, and then they made their next decision, with all of that information already in hand. While the rest of the market was still asking what had caused the halt, the smart money was already 3 moves into the answer.